Understanding repo rate. The repo rate, or repurchase rate, is a key monetary policy instrument used by central banks to control the money supply and influence the overall economic environment. It represents the interest rate at which commercial banks can borrow short-term funds from the central bank by selling government securities with an agreement to repurchase them at a later date. The term repo is derived from repurchase agreement, reflecting the contractual nature of this transaction. In the repo market, a commercial bank needing funds to meet its short-term liquidity needs can enter into an agreement with the central bank. The bank sells government securities, usually treasury bills, to the central bank and agrees to buy them back at a slightly higher price in the future. The difference between the sale and repurchase prices, along with the duration of the agreement, determines the effective interest rate, which is the repo rate. The repo rate serves several crucial functions in monetary policy. Firstly, it acts as a tool for liquidity management. By adjusting the repo rate, the central bank can influence the availability of money in the banking system. When the central bank raises the repo rate, borrowing becomes more expensive for banks, leading to a reduction in the money supply as banks are less inclined to borrow. Conversely, lowering the repo rate makes borrowing cheaper, encouraging banks to inject more money into the economy. Secondly, the repo rate has a direct impact on interest rates in the broader financial system. Changes in the repo rate influence the cost of funds for commercial banks, which in turn affects the interest rates they charge on loans and pay on deposits. When the repo rate increases, banks often raise their lending rates to maintain profitability, making borrowing more expensive for businesses and individuals. On the other hand, a decrease in the repo rate typically results in lower interest rates for loans, stimulating economic activity. Thirdly, the repo rate plays a pivotal role in managing inflation. Central banks aim to maintain price stability, and the repo rate is a tool to control inflationary pressures. By adjusting the cost of borrowing, the central bank can influence spending and investment, thereby impacting overall demand and price levels in the economy. In summary, the repo rate is a crucial monetary policy tool that central banks use to manage liquidity, control interest rates, and influence economic activity. It is a dynamic tool that central banks employ to achieve their dual mandate of price stability and sustainable economic growth. Monitoring changes in the repo rate provides valuable insights into the central bank's stance on monetary policy and its efforts to maintain a healthy economic environment. Thanks for watching. For more, please like, share, and subscribe.